In September 2017, Toys R Us filed for bankruptcy. Every headline blamed Amazon. Amazon had been selling toys for a decade. Walmart and Target had been selling toys for 2 decades. The toy business was not dying. Toy sales were growing. The popular version of this story is that the internet killed the toy store. That story skips the part where 3 private equity firms spent $6.6 billion to buy a profitable retailer, loaded it with $5 billion in debt, and then collected hundreds of millions in fees while the company spent the next 12 years unable to invest in anything that might have saved it. This is not a story about Amazon. It's a story about a balance sheet. Toys R Us was founded in 1948 by Charles Lazarus, a World War II veteran who opened a baby furniture store in Washington, D.C. He noticed customers kept asking about toys. By 1957, it was a toy store. By 1978, he'd taken it public. The store's genius wasn't the merchandise, it was the format. A warehouse-sized box filled floor to ceiling, with every toy imaginable, at prices department stores couldn't match, with a selection no single department store could touch. For an American kid in the 1980s or 1990s, walking into a Toys R Us wasn't a shopping errand, it was a destination. By 2004, Toys R Us had roughly 1,500 stores worldwide, $11 billion in annual revenue, and was the largest dedicated toy retailer on Earth. Charles Lazarus had built the original category killer, a retail format so dominant in its niche that it had trained an entire generation to think of it as the place toys lived. The jingle said, "I don't want to grow up, I'm a Toys R Us kid." The business model said the same thing, just less catchy. In 2000, Toys R Us signed a 10-year exclusive deal with Amazon. Toys R Us would be the only toy retailer allowed to sell toys through Amazon's platform. In exchange, they paid Amazon to host their storefront and handed over their e-commerce future entirely. At the time, it seemed like a rational play. Building and operating your own e-commerce infrastructure in 2000 was expensive and technically difficult. Amazon was already good at it. Why not partner? In 2000, e-commerce was less than 3% of total retail. .com companies were collapsing across the board. The idea of building a 9-figure digital infrastructure to compete for a market that small looked on paper exactly like the kind of internet bet nobody wanted to make after watching the Nasdaq lose 78% of its value. Outsourcing to Amazon in 2000 wasn't a crazy call. What came next was, Amazon violated the deal. They let third-party sellers list competing toys anyway. Toys R Us sued. They won in 2006, but by the time they won, they had no e-commerce of their own. 6 years of the internet, gone. A leveraged buyout works like this. A private equity firm identifies a company, borrows most of the purchase price from banks and bond markets, uses the target company's own assets as collateral, completes the acquisition, and then puts the debt used to buy the company, onto the company's own books. The company now owes the money that was used to purchase it. In 2005, KKR, Bain Capital, and Vornado Realty Trust did exactly this to Toys R Us. The purchase price was $6.6 billion. Roughly $5 billion of that was debt borrowed against Toys R Us itself. The company was profitable when they bought it. It generated real free cash flow. Under normal circumstances, that cash could have gone into new stores, better technology, a real e-commerce platform of its own. After the buyout, that cash had one destination: debt service. $5 billion in debt at mid-2000s interest rates meant roughly $400 to $500 million in annual interest payments. Every year, before a single employee was paid, before a single store was stocked, before a single dollar went to e-commerce or capital investment, up to $500 million a year walked out the door to service a debt the company had taken on in exchange for nothing except a change of ownership. The debt wasn't the cost of growing the business, it was the cost of being bought. Between 2005 and 2017, Toys R Us spent the large majority of its operating income servicing debt rather than reinvesting in the business. Competitors were not standing still. Walmart and Target had been adding toy sections and cutting prices for years. Amazon was growing its toy selection aggressively. An unencumbered company with $11 billion in revenue could have built a real e-commerce operation, renovated its stores, and competed. Toys R Us was not unencumbered. The stores deteriorated. Former customers who had grown up going to Toys R Us as a destination came back in the 2010s and found the same fluorescent lights, the same dated layout, none of the investment that might have made the experience worth the trip when ordering the same toy from your couch had become the obvious alternative. This is sometimes described as a failure of management. It was, more precisely, a failure of available cash. In September 2017, Toys R Us filed for Chapter 11 bankruptcy, not to liquidate, but to restructure. The plan was to use bankruptcy protection to renegotiate the debt load and emerge as a leaner operation. The company still had nearly 800 stores globally and a brand that every parent and child in the world still recognized. The restructuring plan didn't survive creditor pressure. In March 2018, Toys R Us announced it would close all 735 of its remaining United States stores, 33,000 American jobs. The brand that had defined toy retail for 70 years was done not because the toy business was dead, but because the capital structure made recovery impossible. While the company was failing, KKR, Bain Capital, and Vornado had been collecting management fees, an estimated $200 million or more, across the 12 years of ownership. These are standard private equity fees, not fraud, not illegal, just the normal economics of the structure. The firms get paid annually, regardless of the company's performance. The creditors, the workers, and the suppliers find out how the story ends later. Most of the 33,000 workers who lost their jobs received no severance. Former employees organized a sustained public campaign, Toys R Us workers, pressing KKR, Bain, and Vornado to contribute to a severance fund. After months of pressure, the private equity firms agreed to a $20 million fund. To put that in context, $20 million is roughly what the three firms collected in management fees in a single year. The popular version of this story is Amazon killed Toys R Us. Amazon had been selling toys for a decade before the company collapsed. Walmart and Target had been competing in toys for 2 decades. Toy sales in America were growing in 2017, not falling. The toy business was fine. What wasn't fine was a $5 billion debt load consuming $500 million a year in a company that needed that cash to compete. The internet didn't kill Toys R Us. A term sheet did. Private equity gets the credit when the strategy works. When the company it bought collapses under the debt used to buy it, the story gets rewritten as market forces, changing consumer habits. Amazon. The debt disappears from the headline. The fees don't make the obituary. The capital losses version of this story ends the same way it always does. Not with the villain everyone names, but with the decision inside the building, or in this case, the term sheet that made the outcome inevitable. Subscribe to see which company we take apart next.